Assalamu alaikum friends, welcome to lecture 12 of AFM. So this is the second lecture under acquisition and merger and the most important lecture for your acquisition and merger. Okay, because this has lots of calculations and this lecture is going to be very lengthy. Okay, you have to watch it till the end. Otherwise, you will not be able to do questions on acquisition and merger. Let me tell you, if you are planning to give AFM this September and you have not watched this lecture, do not go to your exam hall. Okay, you have to be an expert in this. Okay, because majority of your marks, you might get this question as a 50 marks question. Valuing acquisition and merger. How do you value an acquisition? All the techniques are covered in this. So let's start. Here we have three ways to calculate an acquisition: cash based model, asset based model, market based model. Under all this three methods also we have three extra ways of calculating. Okay, but we also going to go through a risk in acquisition and merger. Remember I told you VAC, we did the cost of capital. I told you cost of capital is relevant in three areas. One, in your investment appraisal, that part is over. Other, in your acquisition and merger, because you have to value company. Okay. Third, in your reconstruction later on, when we again will do reconstruction and reorganization, that time also you need VAC. VAC you can never forget. So most of the things, gearing, de-gearing, asset beta, equity beta, everything has been done in your investment appraisal way back. So those things I'm not going to repeat again. You have to watch those lecture to come here. But how to use a different VAC and how to change, adjust your VAC to value an accusation, that you will be learning here. Okay. Then the valuation of debt. How do you value debt? It's very small portion, very small. Because when you're valuing a company, company also has a debt, right? The other three methods, cash based, asset based, market based, measures your equity. Remember, they value your equity only. Okay, valuation of debt has to be done separately. How do you value high growth startups? Remember, the more methods that you're using, cash based, asset based, market based, are for established business that you have acquired and then. But if you are in a high growth startup, you are in a startup, you have just started and it's a high growth, the way of valuing it differs. Okay. Then problems of overvaluation. See, when you are acquiring a company, it might be most of the time overvalued. That means you have to pay more than its actual value. Why this over problem comes and what are the problems, that also you need to know, because you need to write also in this part. It is not just calculation, value the company using calculations. No, remember you have to write. They will ask you questions on discussion question. They will ask you on acquisition and merger. Okay. So these are the three methods, starting with market base. Under market base, we have market capitalization. That means share price is given. It is published. You take that share price. PE ratio. Okay, you must have known what is PE ratio. That is another way of calculating your market value of equity, your value of equity. And market to book ratio, or you can say it is known as Tobin's Q ratio. We'll see what each of this method and how do you calculate the value. See, the way you value a company differs which method you are using. Okay. Next, cash base. Cash base, we are going to go through dividend valuation. You already know, because in our investment appraisal, we went through this cash based models in detail. We started only with that. So you know what is dividend valuation. This will be easier. FCF, that is free cash flow, and FCFE, that is free cash flow to equity. All this, both these two also we have done. Where? When we had to value our investment for equity. When we have been project for 3-4 years, we have been given free cash flow. Remember? That time we have already done the calculation. But here, we are just going to see how we value a company using free cash flow. Then for asset base, looking at the word asset means based on your asset. So you see the book value, that means what is given in your financial statements, the asset, or realizable value, or replacement value, or intangible. Remember, company has intangibles also, and your book value, realizable value, replacement value, the three methods does not measure your intangible. Intangibles are measured separately. Okay, that is known as CIV, calculated intangible value. Now, before I go in deep in these three methods, let me tell you one thing. from your exam's point of view, how a question will be asked. Will they tell which model to use? Will they tell, okay, use market base, use cash base, use asset base? Even if they say, will they specify, use dividend valuation, use PE ratio? Well, based on what I've analyzed, sometimes they give you, okay, using PE ratio, calculate the value of the company. But most of the time, they don't tell you which method. They don't give you the name of the model or method. That is totally up to you. You have to decide. But again, let me tell you, even if you have a choice to decide, does not mean you actually have a choice. Why? Depends on the information that is given to you. You have to decide. For example, if you are given dividends, you are given dividend growth, automatically you know dividend valuation model you have to use. If you are given free cash flow, you are given the growth rate, you are given the cost of capital, automatically you know you have to use free cash flow. If you are given the PE ratio, you know it is PE ratio. So depending on the information that is given to you in the exam, only you can decide which method you have to use, which is the most suitable method to use. If you are given PE ratio, there is no point of calculating dividend valuation. There is no point of measuring using FCF. You cannot do it. So understand this point. Even though you're studying all these 9 or 10 models of calculating or valuing a company, in the exam, okay, you need only one or two, max two. But most of the time is one method. One method only will come. But to know which one, don't predict. Don't tell this time you're going to get FCF. Don't tell this time you're going to get book value. You never know. Anything can come. But you have to be prepared. You have to know all the 10 models. You have to be prepared so that if anything comes, you're okay with it. And it's very easy. Don't worry. It's nothing difficult. The word looks a little heavy. I know. I can understand. You might be panicking. How will I remember so many models? What if I get confused with each other? For example, dividend valuation, I will do FCF. PE ratio, I will do market capitalization. No, you will not get confused. Trust me. That's why I'm slowly taking you there. I will take you in such a way you will never forget the methods. You will, in fact, love it. I know most of you have problems in valuing valuation. I know this is the topic which most of you have been waiting, requesting me for days, and which I was not able to do it because I've been giving SBL lecture, right? But anyway, that's a different story. So coming back to AFM, this is a very tricky area. I know that. Even though it sounds easy, looks easy, when it comes to the exam, trust me, it is very tricky, very challenging. Students often panic. They make silliest mistake. They forget the things what they have learned. Trust me, it happens, especially in this area. Not like your risk management or investment appraisal, but this area, because this area is new also in AFM. It is not so much taught in financial management, not in detail, right? So that's why. Don't panic. You have to master each one of this one by one. And then in the exam, when you see the information, you should be able to identify which method to use and accordingly use the method and find the value. Even if your valuation is wrong, don't worry. At least for the choosing the method and working based on that method, you will get maximum of marks. Maybe 1 mark you will lose for the final answer. It does not matter. Okay. So just follow with me and you will find all these methods very easy. Okay. So starting with, okay, let me give an overview of the valuation model before we start in detail. Cash based. Cash based means you take the future cash flow. That means you have to have a cost of capital to discount your cash flows. Already this is done in your net present value. So this will be easier for you. Cash based. Most of the time, what I have seen, these two methods are given. One is PE ratio, one is free cash flow and dividend valuation. These are the three. Okay, now I'm very scared to tell also because if I tell something, students often take it very seriously to your heart and they're like, okay, ma'am told this three means only this three I will learn, this three only will come. No. But what I have seen in the past paper, I'm telling you. Maybe you have not gone through the past paper. If you have not gone through the past paper, you are not in a good state because by now you must have done past paper. Few of the past paper you must have done, right? This is the last week. If you have not done, please go and do check. But this, if you see, these three methods always comes most of the time. Free cash flow, dividend valuation model, or PE ratio. I don't know the reason because maybe it is easier or maybe, more things can be asked. Examiner can twist and turn and ask more questions on these areas maybe compared to asset based on things like that. Maybe. We don't know, but this areas has been asked. Especially cash based method is most of the time asked compared to market based and asset based. Okay, but this will be easier for you because you have studied how to find cost of capital and how to discount and all. Same method. The only thing is, when you're choosing the WACC, you have to choose a WACC for the combined company, not individual, two separate individual companies. And how do you find the WACC for that combined company is the area that you have to learn. But all the theories that you have learned before, calculating asset beta, then finding equity beta, re-gearing, de-gearing, everything is same. There is no change in that. If you have followed my previous lecture on investment appraisal, especially WACC, this is nothing for you. Trust me, this is very easy for you. That's why I followed from that order. I first started with investment appraisal, then risk management, then I came to this. Okay. That's the reason why I've started this way. So that's the reason. Second, market base. Market base means information you get it from the market only by seeing the PE ratio or the share price. Okay. But remember, there is an assumption here. What is it? That market values the business consistently. But it's not always like that. Okay. Asset based. You see the asset of the company that is given in your statement of financial position, but tangible only. Okay, it does not include intangible. That's why for companies like Google, it's very difficult to use this method. Why? Because most of their values are in the intangible assets. So this method cannot value that. Understanding? That's why there are other methods to value intangible. So what do? Using asset-based method, you value the company. Using intangible value asset, you measure the intangible asset, add both together. That's how you find the value of the company. That will go later in the intangible asset. Now, starting with free cash flow method. Free cash flow, how you calculate? Free cash flow to equity, how you calculate? Already I've discussed in my investment appraisal lectures. You have to go back and see the free cash flow lecture. I don't remember which lecture number, don't ask me, but you have to go back and check. It's there, it will be there. You have to check by the title of the video. So there you have to go back if you forgot. So I'm not going to repeat it here, but here I'm going to use this to value a company. That's it. These are the 6 steps that you have to do to calculate a company using free cash flow. Number 1, during the planning horizon. See, planning horizon means they will tell you the cash flow for 3 years, 4 years, 5 years. Okay. So for that time, that means they will tell the project is for 4 years, the project is for 5 years. That means it's in a planning horizon, 5 years horizon, 4 years planning horizon, anytime. That is known as during the plan. The other one is after the planning horizon or beyond the planning horizon. That will come to it later. So during this planning horizon, whatever the cash flow is given, discount using WACC. But remember, this WACC is the combined company's WACC. You have to calculate it. WACC which is given to you, you cannot take it. It is for the individual company. Sometimes, if you are lucky enough, they will give you the WACC also for the combined company, but very rarely, if you are lucky enough. Second, beyond the planning horizon. This is after that project year. They will tell you, right, after 3 year onwards, this is the growth rate of the dividend or the cash flow. Cash flow keeps on growing forever. That is the meaning of planning beyond the planning horizon. There also you have to find the present value of that cash flows, but the growth rates might be different. That was there during the planning horizon. This time it will be different growth rate. Another word for that is known as terminal value. So basically you add your step 1 and 2. Understanding? That is the value of the firm. Add step 1 and 2, that is the value of your firm. From that, deduct debt, because remember, we are only interested in finding the value of equity under all the 3 methods. Understand this. That's why we always deduct value of debt. So value of firm minus value of debt. Then what we get is known as value of equity. So in short, in summary, this is how you find the value of company. Add step 1 and 2, deduct your debt, and you will get the value of equity. Now, let us do questions on free cash flow. Using free cash flow, we'll value a company. Before we move on to our next method, that is the dividend valuation model. So this is the first question under valuation of company where we are using free cash flow. You are supposed to calculate the current value of the firm and the value of the equity. Remember that these 2 things are not the same. Okay, one is value of firm, the other one is value of equity. The difference is value of firm also includes debt. And when you're finding value of equity, you deduct the debt. That's the only difference. So here you have been given planning horizon for 3 years. Okay. And this is the planning horizon. Okay. Returns are likely to grow each year for the first 3 years, after which they will reach a steady rate. And free cash flow are expected to be 2.5 in the first year, 4.5 in the second year, 6.5 in the third year, and stock market value of debt is 5 million and company's cost of capital is 10%. Okay. So the total period that is given is for period of 15 years, where the first 3 year is the planning horizon, and after 3 year, that means from 3 year onwards till 15 year, it is beyond the planning horizon. Okay. How do you start this question? See, think this question same like how we do net present value. We start with cash flows, right? Inflow, outflow and all. Here, it is just free cash flow, no inflow, no outflow. So free cash flow only we take and start discounting it by 10%, right? So it will be like this. I'll be doing it this side. Okay. You'll be having 3 separate years. Year 1, year 2 and year 3. So free cash flow for the first year is 2.5. Second year it is 4.5. Third year it is 6.5. But you have to add another column. What about year 4 to 15? That is beyond planning horizon. How much? Whenever you have to take for year 4 to 15, you will always take this one, the previous year's one. Okay, 6.5. In short, this and this will always be same. Okay. Now, the present value at 10%. So use 10% and start discounting. So I will not be giving you the decimal answer that you can use the table and get it. Okay, I will give you the final answer, that is the present value, which will be 2.273, 3.717, 4.882. Okay, I have to give you the present value because I will tell you why. You just have to multiply with the present value, 0.751. When you come to year 4 to 15, what do? Remember, 4 to 15, you have to take the annuity factor. Okay. How many years? See, out of 15 years, 3 years went. Remaining is 12 years. So you have to use an annuity factor for 12 years at 10%. Okay. Which is here. The annuity factor, right? It is, if you use the table, 12 years at 10%, it will be 6.814. You have to multiply it by 6.814. The 6.5 needs to be multiplied with 6.814. But remember, this you have to discount. Why? Because this initially you have to bring it back to year 0. You have to discount it and bring it back to year 0. That's what you have to do. And when you're using it, which discount factor are you using it? This year, third years. Third years. Because I will tell you why. So that means you will further multiply this. Again, you will multiply by 0.751. This one. So in short, fifth year, year 4 to 15, it will be 6.5 into 6.814 into 0.751. Okay, why this one? Because after the planning horizon is for this 3 years only. Beyond 3 years, it will be taken as that, as if it is on the third year only. That's why when you discount, you have to take the third year's discount factor. After the planning horizon, whatever the year it is, you have to take this only, the third year's discount factor, always, for any question. That's how you decide. Okay. Now, once you get, so after multiplying it, the present value will be here, 33.263. which you need to multiply with the debt. Okay, when you add all this and this, the total will be 44.135 present value, but you have to deduct debt. Debt is 5 million. 5 minus 5, which will give you 39.135. So this is the value of equity, this is the total value. Okay, now for the same question we have, this is how you value a company using free cash flow. Here same illustration. Now they believe that earnings after the planning horizon will continue at year 3 level into perpetuity, that means forever, or grow at 0.94% per year into this one. Now the situation will change. First we'll do with A. It will continue at year 3 level, the earnings. Okay, so how do you do that? I'm not doing for year 1, year 2, year 3. You can see it above. It is as same as it is. The only change came in year 4 onwards. What is the change? See, whenever they never give you a growth rate, they say that continue at year 3 forever. Okay, this is how you calculate. There is no annuity factor this time. Okay, year 4 is 6.5. This is the free cash flow, right? Present value at 10%. When you're taking this one, okay, you just take this 1 divided by 0.1, that's it, because this is the formula for perpetuity. 1 divided by 0.1 because discount rate was, cost of capital was 10%. Okay, and then you multiply this with year 3's discount factor, which is 0.751. Because every time you have to bring it back to year 0. Okay, so now what happens? Now if you find out like this, basically you are multiplying 6.5 by 1 divided by 0.1 by 0.751. The value will be 48.815. The total value adding 1, 2, 3. See here 1, 2, 3 will have no impact. It will remain same as the previous one. So when you add, okay, I will write the total here. It will be 59. You have to add it by yourself and check how much. But you have to get 59,687. Again deduct your debt and get the value 54,687. Here you are getting 54,687. We'll go and check. Previously you were getting 39.135. Now you are getting a higher value. You see what happened? When you alter the time horizon, when you change the time horizon, value increased. Now grow at 0.9%. We'll do for B also. For B, how do you do? B, year 1, year 2, year 3 present value will be same. That means free cash flow and discount at 10%. Only the change will happen in year 4. Year 4 till infinity. That means year 4 forever. Here. Okay. Just what would be the present value? See, you need a working here. Okay. What is your free cash flow for year 4? 6.5. You need to multiply this with the growth rate. Growth rate is 0.9%. That means it will be 1.009. You have to add with 1, right? The growth rate. This divide by, what is the cost of capital? 10 minus the growth. Because this is the formula, dividend valuation formula or the growth model formula. Multiply this again with the year 3's discount factor. You have to bring it back. It will be 54,126. So if you add it with year 1, year 2, year 3 and deduct your debt, debt is 5, the value will be 59,998. This gives the highest value. You understanding? The main thing is not the answer. The main thing is you should know the steps to calculate. Automatically your answer will be correct. So try doing this by yourself. Now we'll be moving on to the next model, that is dividend valuation model. The dividend valuation model. Even this also you have done it earlier in investment appraisal, so things will be a little easier. Like we have the growth rate, the dividend, cost of capital, all those things are given. So here we are finding the value of the share. Okay. And how do you find it? It is the present value of the expected future dividend that is discounted at the shareholders' required rate of return. Assuming a constant growth rate in dividend, that would be G. So this is the formula, 1 plus G, that is 1 plus growth rate, multiply with the current dividend, divide by cost of equity minus growth. Okay, that's how you find the value of the company. Same you have to use. Note that if you're finding total dividend, okay, if you're using a total dividend for D0, your P0 will be total value of the company's equity. And if you're using dividend per share, P0 will be value per share. So it's per share for per share, total for total. That's how it goes. This you need to understand. Because sometimes the question asks total value of the company, sometimes they ask what is the value per share. If it's value per share, you have to use dividend per share. Do not forget this. Now, some limitations. See, this model is based on some assumptions and the model is highly sensitive to changes in these assumptions. If assumption changes, model changes, very sensitive. For example, where growth is high relative to the shareholders required return, that means growth is more than your cost of capital or cost of equity. What happens? Share price is very volatile. It's very volatile, which is not so good in terms of planning and budgeting. Second, even a minor change in the growth rate. Remember, even a minor change in the growth rate can cause a major change in the share price. Sometimes it can contribute to the share price crashes also. So this is very sensitive. Okay, why did I include this now? Because sometimes you might have to write limitations about the model. They ask, if you're using a certain model, you might have to give limitations, especially if you're writing this as a 50 marks question. If you're writing a report, you might have to talk about assumptions, limitations. You have to know each model has some, it is based on some assumptions and you have to know these assumptions. You have to state it. That's the reason. AFM, in AFM, whatever model you use, there will be some assumptions. You have to know all the assumptions because you have to list the assumptions, whether the question asks you or not. Okay, so this is one of it. Now, before moving on, we are done with cash-based method, the two methods, that is free cash flow and dividend valuation model. Now we are going to do a small question on dividend valuation model before we move on to the market-based methods. So let's do the question. In this question, you are using dividend valuation model under three different scenarios. Okay, first, no growth in dividend. Second, constant growth of 5% per year. Third, constant dividend for 5 years and then growth of 5% per year to perpetuity. Okay, this is a very good question because this one question alone is enough for you to do dividend valuation model under any circumstance, whether growth is constant, whether there is no growth, whether growth forever, all three conditions in one question. That's a very good question. Okay, but that does not stop you from doing other questions from your revision kit and past paper. You still have to do it. Okay, go and search for it. I have already solved the revision kit. There is a playlist. You don't have to wait for me to finish the lecture. I will do it before your exam. Don't worry about it, but you have to do your practice. Okay, all by yourself. Now, they have paid a dividend of 25 cents per share. Return on this equity in this class is 20%. Okay, so what else? Let's do with the first one. First, there is no growth in dividend. Okay, so you just divide it by cost of capital, 0.25 divided by 0.2, which will give you $1.25. Okay, in the second, there's a constant growth of 5% per year. So you multiply your dividend 0.25 with 1 plus growth rate, that is 1.05, and you deduct 20% is your cost of equity minus growth, which is 5%, will give you $1.75. And the third, okay, Remember, the third step you have to do it in 2 stages. Because first 5 year there is one growth, okay? There's a constant dividend. Sorry, there's no growth, constant dividend. After that, there is 5% growth forever. So first you have to do the first 5 year, and after 5 years is a separate thing, and add both. Okay. So when you're doing it for the present value of first 5 years dividends, how do you do that? Take the dividend. Okay. I will do it here. 0.25. Multiply this with annuity factor for 5 years, because you have to discount it. And the thing is, dividend is in all the 5 years, dividend is the same. That means cash flow is the same. So we have told that when cash flow is same, when you have to discount, you don't have to discount separately all the 5 years and then add. No, just take the annuity factor because it's the same, right? And take it. So annuity factor will be for 5 year at 20%, which will be 2.991. Please go to the table and check this out by yourself. Then you will understand how to read the annuity factor table also, which will give you 0.748. Keep this aside. You need the 0.748 later. Now, you can call it as terminal value after the planning horizon. After 5 years, it is known as terminal value. So how do you do this? You have been told that dividend is 0.25, growth is 5% forever, right? Divide this, cost of equity 2, growth is 0.05, okay? Multiply this whole thing by the 4th years, 20%. 4th year, 20% discount rate, which will be 0.402. You can use this table and find it out because I have to discount it, which will give you 0.704. Just give me a minute. Yes, so 0.704. Add both of this, which will give you 1.452. You see, this is the share value. This is how you have to calculate. Now, let us go to the market-based method. So the first method under market-based is stock market value, or you can call it as market capitalization. Here, this can be used for the listed company. You'll be given the stock market value of the shares. So basically, this is the starting point for your valuation. Okay, but remember, you usually have to pay a premium above that current market price so that you can acquire a controlling interest. Okay. Next method, we don't have a question for the stock market valuation, okay, from the textbook. We are moving on to the next method under market-based method, that is the PE ratio. Okay, so for the PE ratio, this is how you find the value per share. You need to memorize this. You need to memorize this. Formula is not there in your formula sheet. The best way to memorize is do enough of questions until you know it. You don't memorize EPS into PE ratio, EPS into PE ratio. That's not how you memorize. There's a way to memorize. The more and more that formula you use, actually apply in the question, more and more you will remember it over a long period of time. That's how I used to practice formulas. I never memorized from the list like this, EPS into PE ratio, EPS into. What if I forget? You will forget it, trust me. That's a short-term memory. But if you think you can go ahead with it, there is no harm in it. As long as you remember it and you are able to apply it, use whatever method you use to memorize, but you have to know it. That's all what I want to say. So value per share, EPS and PE ratio. Now you see there are two things that you have to know. One is EPS, one is PE ratio. You have to know to calculate them also both separately. But obviously you'll be given the EPS or the PE ratio. So once it is given, that's how you find the value per share. Now if you have to find the total, most of the time it is the total equity value. Okay, so when is the total equity value of the company, remember, formula changes. How? Your EPS becomes total post-tax earning. Remember, post-tax, after tax. Why? Because equity shareholders get after paying everything. Interest, after paying tax, the tax charges, then whatever is remaining, that only equity shareholders get. That's why it is post-tax earning, after tax, not before tax. Okay, and they will give you the post-tax earnings. Don't worry. P ratios they will give you. You only have to know how to find the equity of the company and multiply by PE ratio. Okay. Now, PE ratio is, remember, higher the PE ratio, better it is, because that suggests that your company is growing. Understanding? You have to understand how to interpret, because you have to write also. Calculation is not enough. What does high PE ratio indicates? What does low PE ratio indicates? You have to able to talk on this. So based on the PE ratio, you can say what is the future and the current market position of this company. You understand? If the PE ratio is high, what does it indicate? Company has a high share price compared to its earnings. That means this has a good growth prospect. The share price, high share price itself tells that this company has a good growth prospect. That means in the future, this company will be able to grow very high. That's what it suggests. But limitation is, for unlisted company, there is no market share price. So you cannot easily get a PE ratio for unlisted company. Remember, in your AFM exam, you might be given unlisted company also. Always look, is it listed or unlisted company? If it is listed, no problem at all. Take it. Unlisted, you have to adjust, because readily available PE ratio you will not get. But good thing is you can use a proxy PE ratio from a similar listed company for an unlisted company. Okay. Now, strengths and weaknesses of these valuations. As I told you, you have to know the strengths and weaknesses of each method. Starting with number one, this is commonly used and very well understood. Everyone understands PE ratio. High the PE ratio, better it is. Easy to explain also. And even in your exam, this is one of that method which is mostly asked. So you can be very sure that if this is asked, you'll be able to tackle it, because you have seen the past paper how this is tackled, rather than something which has never been asked before. Okay. Second, relevant when you are acquiring a controlling interest. When you want to value a controlling interest, PE ratio is very much valuable, relevant. Weaknesses is number one, remember, PE ratio, price earning ratio, earnings, it is based on accounting profit rather than cash flow. And we know accounting profit you can easily manipulate. Cash flow you cannot do that. Second, difficult to identify suitable PE ratio. Why? First of all, even if you find a suitable company, but that suitable company is a listed company, their gearing, their financial, their business risk is different to yours. Especially when you're valuing this for an unlisted entity, right? Third, difficult to establish the relevant level of sustainable earnings. Price earning, you need a sustainable earning there. And it's very difficult to establish that relevant level of sustainable earning. So these are some strengths and weaknesses. Make sure you're able to talk about it when you're using it. Now we'll be doing a question on PE ratio before we move on to the next method. This is the first question under PE ratio. We have another more question. Okay, so test your understanding 4. This is test your understanding 4. Moliere is an unquoted entity with a recently reported after tax earning of 3,840,000. It has issued 1 million ordinary share. A similar listed company has a PE ratio of 9. How do you calculate the value of one ordinary share? Hmm? Tell me. It is PE into EPS. That gives you value for one share. Do we know the PE? We know it's 9. But do we know the EPS? No. Calculate EPS. What is earnings per share? So earnings is 3,840,000. Divide by number of share, which is 1 million, which will give you 3.84. So it is 3.84, which will give you $34.56. So this is the amount. Value of one ordinary share. Always see whether they are asking for value of one ordinary share or total value. Okay. Now we are moving on to the next question on PE ratio. That is test understanding 5. In this question, you are supposed to calculate the minimum value that is acceptable to this shareholder and maximum amount which ABC should consider paying. This is an exam style question, right? Even in the exam also, this type of question had been they had appeared, right? So pay very careful attention to this question. How I'm doing, how I'm proceeding. ABC is considering making a bid for the entire equity capital of XYZ. Who is the target? Who is the acquirer? Remember, the one who is going to acquire is known as acquirer. The one who is being taken over is the target company. Okay. It's very important that you know who is taken over by whom. P ratio of 9. Annual earning 390 million. Whose earning is this? XYZ. Target companies. ABC has a P ratio of 13. Annual earning is given. 125 is the synergy. You know what is synergy? In my previous lecture, I told that when you acquire, you get a benefit, synergy benefit. What is synergy and all? You have to go to my previous lecture and see, okay? The types of synergies and what it is. Now, the PE of the combined company is 12. You see, PE is of XYZ is 9, of ABC is 13, of the combined is 12. It will be in between both. Now, how do you start this question? See, the minimum acceptable value to XYZ shareholder and maximum amount. Two things you have to find out in this. If you can understand this, that there are two requirements in one. Please understand the catch. This is not one. You might be thinking for them what is minimum value acceptable is the maximum amount that they have to pay. No, it's not the same. You are going to get two values here. And even in real life, okay, because this is you are doing it in an exam, you are getting one value, valuation for company. But in reality, if you work, if you actually start valuing company, you will never get a precise value. Remember this. I have even done a separate course on that, valuation of a business valuation. So I know that you can never be able to calculate precise. Never happens. You will always be given a range. Whenever you are talking about value of a company, you always give them a range. That this is the range. Value can come anywhere in between this range. Now you see whether it is acceptable or not. This is how it works. But for the purpose of AFM exam, in order to make things easier, we give one precise value only. Right? But anyway, let's come back to our question, which is minimum value. First, let's start with the minimum value that would be acceptable to XYZ. What is it? Minimum value. Okay, acceptable value to XYZ shareholder is the current value of equity. What is the current value of equity? First find XYZ's PE ratio, that is 9. So that PE ratio into your annual earnings, that is 390, which will give you 35110 million, isn't it? See, what is your current value of equity? Only that much only you are going to pay, right? Forget about premium and all, that will come later. Obviously, you'll pay a premium or you might negotiate and pay less, but that's a different story. Right now, whenever you have to calculate how much you are accepting, how much you are paying, in short, we are finding out the current value of equity. So what is the current value of equity of XYZ? That's what we found just now. So whatever the value of XYZ, that much amount only, that is a minimum that they will accept. That means if they have to go on the higher scale, it will be more than that. This is the minimum, is lowest amount. Below this, they will not come down because this is their value of equity. That is the meaning of this. Understand? Okay. But remember, who is taking over whom is very important here. Here, he is the target company. From ABC's perspective, he is going to get a benefit also. You have to talk about the synergy benefit. Okay. Obviously, there will be some benefit of joining the two companies. That is the synergy benefit, value of joining two companies. In short, I'm repeating again, synergy means sum of two companies, okay, will be greater than the value of the two individual companies. It's like 2 plus 2 is not 4 but 5. That additional 1 is the synergy benefit. You understand it? Same thing here. So now if you have to find the value of XYZ to ABC for the acquired company, what is the target company's value? How do you find out? That is value of the combination or combined company's value. From there you deduct the value of ABC. For the moment. Okay. Whatever amount is, that would be the maximum that ABC would like to pay. Okay. So what is it? First find out the value of the combined company. How do you do that? Combined company's PE ratio, that is 12 into total focused earning. When you're taking the total focused earning, remember, add 693 with 390, add both the company and also the synergy benefit. With this you are taking the PE ratio, combined company's PE ratio. 693 plus 390 plus 125 minus what? Value of ABC. Value of ABC, you have to take the P ratio of ABC, that is 13. Multiply by just the earnings of ABC, that is 693. You have to do this several times to understand this, which will give you, remember, first you have to multiply by 12 all after adding all these three, then you deduct 13 minus this one. So in short, it will be 14,496 inside the bracket when you multiply it by 12, and 13 into 693 will give you 9,009. So in short, it is 5487. You see here, this is the minimum, this is the maximum they will pay. Obviously, minimum will be less than the maximum. So somewhere between this range, the value will fall. This is the reality actually. Then you negotiate, right? So now let us go to another method. Earnings yield method. Okay, this has something to do with your PE ratio. This I have not explained in that table in the beginning, right? When I was explaining the overview of all the three methods, this was not there. But this has to do with PE ratio. Sometimes in your exam, they might not give you PE ratio. Rather, they might give you earnings yield. Okay, how do you work with it then? If they give you earnings yield, remember earnings yield is the reciprocal of PE ratio. Reciprocal means 1 divided by PE ratio, earnings yield. So when they are giving you the earnings yield, you have to convert it into PE ratio, remember. Through earnings yield, you have to get the PE ratio. Earnings yield is nothing, just the reciprocal of PE ratio, 1 divided by the PE ratio. Okay. So hence, if you want to find the value of the company, just divide total earnings. Earlier, what were you doing? You were multiplying earnings with the P ratio. This time you divide by earnings yield because reciprocal. So total earnings divided by earnings yield. If it's value per share, it is earnings per share divided by earnings yield. So you have to see value for the company or value per share. This is very important, that one word of and per makes a huge difference. Please, that's why I've highlighted it in bold. Do not make this silly mistake. I repeat, do not make this silly mistake. Check each word carefully. Read value per share or value of share. because earnings yield remains same, but your numerator changes from total earnings to earnings per share. That's why. Now we are moving on to the last method under market base before we move on to the asset based method. That is Tobin's market to book ratio, or you can say Tobin's Q ratio, another name for it. Here you have to find the market value of target company. So market value of target company is what? Simply, they will give you the ratio, market to book ratio, multiply by the book value of the target company's asset. Book value and all, they will either they will specify that this is the book value of asset, or they will give you the statement of financial position through which you can take the asset, that would be their book value, and multiply the ratio. Okay, now market to book ratio, how do you get the ratio? They will give you, it's an industry average or for a comparative company, they will give you. Okay, so this method assumes that there is a constant relationship between the market value of equity and the book value of firm. They believe that the book value of your firm is only the market value of your equity. That means all the assets, if you add, is the value of your equity. That is just an assumption. But there's a problem with this model also. Number one problem is choosing an appropriate comparator. Remember, for that ratio, market to book, you are choosing a comparator. So when we are taking it, which things should we take to compare? Should we use the industry average or an average of the similar firms? What do you take? It's a problem. Next, the ratio to market applies is not constant throughout its business cycle. Remember, throughout its business cycle, this ratio will not apply. It will keep changing. So strictly, the comparator should be taken only from the companies at the same stage. When you're taking something to compare the ratios, you have to take it from that company which is as same stage as you. Otherwise, if they're in a different stage, ratio will be different. So that's another problem. Now let us do a question on Tobin's Q ratio before we move on to the last method, that is asset-based method. So here the industry average has been given and you have been given the book value and also the shares. You have to calculate the share price. Okay, so it is told that the book value into the ratio. So book value is 3706 multiplied by the ratio, which is 4.024, which is 14912.24. Okay, 24 million. This is the total value. Remember, the question asked predicted share price. Share price means per share. They didn't ask the total value. So you need to divide this by the number of share, that is 1500 million, which will give you $9.94. Understanding? This is the value per share. So now let us move on to our asset-based method. So the last method, that is asset-based. Okay, the starting point is from your financial statement. You deduct your liabilities from your asset. Okay, now asset values could be this value, book value, which you usually get it from financial statements only, right? But remember, book values are not so accurate or reliable method. Why? Because they are based on historic cost. So they are not a good reliable indicator of current market values. Okay. Now, second is replacement cost. You can take replacement cost also as an asset value. Here, the buyer will be interested in the replacement cost because they want to know what is the cost of setting up a similar business from scratch, or replacement, sorry, net realizable value. This is from the point of seller. He wants to know what is the realizable value of the assets as a minimum acceptable price in negotiation. But remember, however, replacement cost is not easy to identify in practice. It's not easy. Second, business is not just the sum of all the assets. It is more than that. For example, some assets like Google, which has huge of its assets, or the value or the success comes from its intangible assets. not from these tangible assets. So it's hard to use, for them it's hard to use this method, because if you go by tangible assets, their value might be very less. But companies who are heavily in intangible values, huge amount, huge value comes from their intangible assets only, which this method does not measure. Understanding? So compare a firm of accountant with a mining company. Accountants you cannot value, with a mining company has lots of tangible assets. So in terms of value, they'll be high. But if you have to compare them with accountants, accountants are giving services. They are giving intangible values. So now let us do a question on 2 questions on this. In test your understanding 6, you have been given the statement of financial position, and from here you have to calculate the value of one ordinary share. Right? What do? Just add up all the assets, deduct your liabilities. When you're taking your assets, you are adding both non-current with current assets and deducting your liabilities, that is both long-term and current liabilities. Okay, so when you, from here 32,000, you're deducting this 12,800, which will give you, okay, when you're deducting both, it will give you, I will write it here for you, 32,000, 12,800, 19,200. But that's not enough. You have to find value per share. You have to divide this with number of share. What is the total number of share? Here, this 8,000. You see? Everywhere you will get it from one place only. So 19,200 divided by 8,000, which will give you $2.4. You understanding? So this is the value of one share. And if you see this, okay, you will also see here that ordinary share plus retained earnings will give you the same value, 19,200. It's the same because your asset minus liabilities, or you can find it the other way around also, your equity, which is 19,200. Now let us do the next test your understanding 7. So here what's happening, they are planning to use replacement cost, and replacement cost of non-current asset is 40 million. So calculate the value of share in Owen from Fowler's perspective. That means now you're going to use the replacement cost. Okay, so with this you have to add another 40 million with your 19,200. Okay, just add 40 more, or 19,200 million, you add 40 million plus 40 million, okay, minus what? This non-current asset. You have to deduct this because instead of 23,600, okay, see why 19,200? You have already included that, okay? From here, you are adding 40,000 and you are taking out the non-current asset. 23,600, you are taking it out. Or in other words, you can start adding all the assets except that 23,600. Instead of that, you can add 40,000, or you can do it like this also. Okay, minus 23,600 million, 23,600,000, or 23.6 million. Whole thing needs to be divided by 8 million because number of value per share, still it's value per share. It will be 4.45. Okay, now we are moving on towards valuing intangible assets. Now we are going to value intangible assets. Okay, so here we do that. Whether you use a book or a replacement cost for the tangible asset, you add it with intangible assets. For the intangible asset, you'll be having a multiplier. Okay, this multiplier will be given to you in the exam. Don't worry. So multiplier into annual profit or revenue. Okay, that will give you the firm value, total firm value. See, when you're taking the total firm value, it has to be the tangible asset. Normally, how you calculate from your statement of financial position, take asset, and for the intangible asset, we use a different method. Add both the parts, that will give you the firm value. So tangible asset valuation plus intangible asset valuation. Here, multiplier. This multiplier is something that is negotiated between the parties to compensate for the goodwill. Okay. So effectively, some attempt is being made to estimate the extra value generated by the intangible assets. So through this, what are we doing? We're just making an attempt to estimate what is that extra value that you get by intangible asset. That is above the tangible asset also. There are two intangible valuation methods here. Okay. And it's very simple. Don't worry. One is known as CIV, that is calculated intangible value. The other one is LAVS method. LAVS method, we don't have a calculation. But CIV, you are definitely going to get it. If intangible asset is asked, this is what you have to use, CIV. What is CIV? We'll see the method, but before that, one more problem is there. See, for normally when we calculate the asset, okay, the tangible asset, the issue with the basic asset valuation model is what? Some assets, we only value those assets that are there in the statement of financial position, correct? But we know accounting, there are so many accounting standards which says that even if it's an asset, you cannot recognize it on the statement of financial position. One examples are intangible assets, right? Even if you have a significant level of intangible assets, but due to your accounting standard, some IFRS or IAS recognition criteria and all those things, you cannot recognize it on the statement of financial position. What happens? So your real value will be below the commercial value. Understanding? It will be below. It will not be the actual value that you get. That the value that you calculate using basic asset valuation model is not your actual value. Value will be much less because either you do not include the intangible asset at all. Even if you include, amount will be very less, below the commercial value. You understanding? So these are the steps you do to calculate intangible value. Okay. Number one, this method is based on comparing or benchmarking the return on assets earned by the company. Okay, you need return on assets. They will give you. In fact, in the exam, they will give you what is the return on assets. So this you compare with you take it from a similar company in the same industry, or industry average only you can take it. We'll see. We'll do a question on this. Don't worry. So if you see this, the way you calculate CIV, it is very similar to your residual income. Do you know what is residual income? Maybe from your early studies you must have remembered or you forgot. Anyway, let me tell you what it is. It calculates the company's value spread. That means the profit it earns over the return on assets. That would be expected for a firm in that business. Even if you don't understand this, don't worry. Know the method, that's it. So, step one. First, find the return on assets. How do you do that? You need a suitable competitor in terms of your size, similar to the size and the structure of your company. Okay? This is how you calculate. Operating profit divided by assets employed. Number two, if there is no similar competitor, use industry average return. 3. Company's value spread is calculated. 4. This is how value spread is calculated. You have to know all the steps. Okay? Company operating profit you take. From there you deduct the appropriate return on assets, multiply by the company's asset base. All these things will be given to you. You just have to know the formula and calculate it. Okay? Then step 4. Assuming the value spread would be earned in perpetuity, how do you calculate CIV? Find the post-tax value spread after tax. Okay? Then, if it is forever, okay, find the post-tax spread, then divide that by the cost of capital so that you find the present value of the post-tax spread. You understanding? Then add that to the net asset to give you the overall value of the firm. The CIV has to be added to the net asset value to give an overall value of the firm. But there are problem with this model also. Number one issue is it's hard to get a similar company, especially in terms of your industry, having a similar asset portfolio, having similar cost gearing, it's very difficult. Second, even your competitor also has intangibles, correct? So when you're calculating or measuring your value of intangible through CIV, what happens? Rather than comparing it over your own asset value, the extra value, the surplus of intangible value, you are comparing it with the competitor because you are taking their ratio, right? So rather than comparing it with your own asset value, you are comparing it with the competitor. That means the surplus intangible value of the company is compared with the asset value of the competitor rather than your own asset value. So that's an issue. Now let us do a question on the CIV before we move on to the next stage of intangible asset, that is leverage method. The first question for CIV, we have two questions. One is this and the other one is test to understanding 8. Okay. Here, the reason I'm doing two questions is to show you that how things are repeated. The more time you do a question, better it stays in your mind. Calculate the value of CXM including the CIV. So CXM operates in the advertising industry and all those things we don't need. What do we need is the value. Okay. Operating profit is this. Asset base is this much. Company's WACC is this much. Competitor has been benchmarking has been done and operating profit is 315. Asset employed is this much. Corporation tax is 30%. Okay. Now, what do you want? UCIV, the steps. You don't have to write the name of the steps and all. Okay. But here, you want a return. First step is return. Okay, I will write it this side. You want return on assets, ROA. How do you get it? You take it from the competitor. When you're taking return on assets, the competitors. This is the operating profit. This is the asset employed. Okay. So operating profit divided by asset employed. Which is 315 divided by 1583. Remember, you're taking the competitor companies, right? Which is because you need this percentage, first of all, 19.9%. Second, value spread. You need to calculate value. How do you do that? Company's operating profit. What is company's operating profit? 137.4. From there you deduct whatever the return you have got into company's asset base. So 19.9%. Company's asset base is what? 307. Because you need here the return on asset to multiply it with the company's asset base, that's why you had to do this. Okay, which is, I will give you the total answer. 137.4 minus whatever is inside the bracket. It is 76.31. Now what else? Step 3. Calculate this one. You have to find post-tax value spread after tax. This is how you find it after tax. Before tax it was 76.31. Just take it after tax. 1 minus 30%. That means 1 minus 0.3. Or you can just simply multiply into 0.7. Which will be 53.42. Okay. Now what else? See, they didn't tell anything. They didn't give you a time period, right? Did they? So if they don't give anything, no time period, you have to assume it will go forever, continue forever. So in this case, you need to discount this by the cost of capital, the WACC. Okay, WACC is 6.5%. So you have to divide it by the WACC. That's it. .065, which will give you 822 million. This is the value of your intangible asset, 822 million. Right? Sorry, this is the post-tax spread, the present value of that. This is not the value of the company. You are still left one step behind. You have to add your CIV with your asset base. That means your tangible assets. So your CIV is 822 plus asset base. What is asset base? 307. It has been given, which is 1129. This is the value of the company. Okay. Same way you have to do test understanding 8 also. Now let's do that. So now you can do it a bit quicker, right? Test understanding 8. It's the same thing. Tax is there. Average return on asset is 16%. WACC is 8%. Operating profit is this. Asset base is this much. Everything has been given. Okay. So what do? Here, one step is less. Return on asset is already given to you. You don't calculate. Okay. So you just start with the operating profit. Okay. Which is 256.8 less return on asset has already been given 16% into asset base, which is 522, which will give you 173.28. This is your value spread also. Now calculate CIV. Post-tax. Okay, I'm not writing all those things. So it's post-tax, this thing, value spread, 173.28 multiplied by 1 minus 0.3, which is 121.3. Okay, assume it will go forever. So divide this by cost of capital, that is 9%, 0.09, which will be 1348. Next, step 3. Add 134, add with your asset base. That is 522, which is this is dollar, 1870 million. This is the value of the company. You see, every step is same. The way you calculate is same, only the figure changed. This time, return on asset is given 16%. In the earlier question, you had to find it out. So in both the ways, if it's given or it's not given, at least you should know both. Okay, don't go and start calculating again, because it's already given. Don't waste time. So you have to see whether it's given or not given. If it's not given, you should know how to find. If it's given, don't waste time finding. Okay, now let us go to the second way to calculate intangible asset. So the second method is known as Lev's knowledge earnings method. Here, this is an alternative method to calculate intangible assets. What do you do here? You isolate the earnings from intangible assets separately from tangible, and then you capitalize them. But remember, this method is more complex than CIV. Okay, especially in determining the returns to intangibles and the future growth assumptions. It's very difficult. So because of this, in practice, this model does produce results that are close to the actual traded share price, suggesting that this is a good valuation technique. But from the point of your exam, you don't have to use this method, don't worry, because it's very complex. It has been criticized as overly complex, right? And why to use an overly complex method to value, whereas valuations at the end are dependent on your negotiation skills between the two parties. So with that, we are over with all the three methods. Under the three methods, we studied further three methods. Okay, we'll summarize at the end. Now, risk in accusation. Two types of risks are there. We have earlier studied this. One is known as business risk. Second is known as financial risk. Business risk means how much your earnings are affected. Okay, maybe because of some uncertainties in the business environment, demand went down, something happened, but your earnings are changing rapidly, going up, down, up, down, up, down. That is a business risk. Especially we are talking from the point of mergers and accusation. Okay, what happens is when you are acquiring a company that is operating in the same business area, the business risk will be unaffected. The one who is acquiring, for him, the business risk will not be so much affected because they're in the same business area. You understand? And business risk is measured by what? You should know this. We did it in investment appraisal. Heavily we were doing asset beta, asset beta. Next type of risk is financial risk. This is regarding your gearing structure. Okay. So if an accusation is of a significant size, that is even bigger than your company that you have acquired. I mean, your target company is bigger than the acquired, what happens? It will change. And or if it requires a change to your capital structure, it will change your financial risk. So because of this, your WACC has to be adjusted. When you're valuing a company, remember, before valuing, you have to find out WACC, because with WACC only you have to discount, right? So it is a key principle that most an acquirer should ever pay for a target company is the increase in the value of the acquiring arising from the accusation. What happens is when you are in a process of accusation, when the news is there, what happens? Value increases. The value of the acquiring firm increases when they are told that they are going to acquire target company, right? So it is rarely a simple matter of just valuing your target and assuming that will be the level of increase that you've experienced, right? But it ignores the impact of some things, few things. Number one, synergy gain. When you're valuing, okay, you might be under or overvalue. Why? Because you're ignoring things like synergy gain. Even in reality, synergy gains are rarely achieved, okay, because there are so many issues which I've covered. Why? In the previous lecture. Okay, but you have to measure them. You have to have an estimate of this in your accusation. Okay, and only then if they are arising because of the target itself, okay, of the target itself, okay, that is, they won't arise from any merger. That means if the value is only from the target, okay, then it will not give you any value if you merge. There is no benefit from merging. The change in the potential risk profile of the combined entity. Yes, sometimes combined entities risk profile changes. Earlier when they were individual, they had separate type of risk. Once they combine, risk changes. So in that situation, you have to change the WACC. Now, the valuation techniques used must therefore depend on the type of accusation being considered. What accusation are you doing? Depend on that, your valuation technique will differ. Now, for example, if a net present value approach is used for evaluation, okay, what happens? You need a risk adjusted cost of capital, isn't it? Which is appropriate to the risk of cash flows also, which we need calculating and use for discounting, right? You have to adjust your WACC. Risk adjusted WACC and adjusted present value are equally relevant in business valuation. Remember, we studied two things. One is known as risk adjusted WACC, where we changed our WACC because risk changed. by the business or financial or both. Next we studied was adjusted present value. By the way, if you have not watched my lecture on this too, please go back and watch. I recommend you to watch it before you attempt this or go any further, because you have to understand what is adjusted present value. I'm not going to explain here again. Okay, so adjusted present value also are relevant for your business valuation also, not just for investment appraisal. So those two things are again coming up here, so don't forget those. Similarly, what about PE ratio? If a price earning valuation method is being used, okay, then the proxy PE used in the calculation must reflect the risk profile and the growth prospect of the company's earnings being valued. You have to change that PE ratio, adjust it a bit because of the risk profile and the growth. Because we are in the risk in accusation, so we have to adjust for risk. Understanding? Now, using a risk adjusted WACC in valuation. This is the method. Step 1. Calculate the asset beta of both companies before the accusation. Step 2. Find the average asset beta for the new combined company after the accusation. Step 3. Re-gear that beta to reflect the post-accusation gearing. That means after the accusation, what is the gearing? The new combined company. Step 4. Combined companies WACC. Step 5. That means one WACC only you will have. Discount that using WACC. Discount the post-accusation free cash flow. And step 6. Calculate the net present value, okay, and deduct the value of debt to give the combined company's value of equity. We are going to do a question on this before we move on to adjusted present value in valuation. How do we do that? How do we use adjusted present value to value a company? Understanding. So in this question, what are you supposed to do? Calculate the gain in wealth for Edison company shareholder if the acquisition goes ahead. Okay, for that you need to read. We don't want to know all those things. Okay, we just want to know that they have different level of risk, so we have to adjust for risk. Free cash flow to focus is 50 per year in perpetuity. Web's free cash flow are focused to be 10 per year into perpetuity. Post-tax cash synergies 5 million. Combined companies tax is 30%. Pre-tax cost of debt is 5%. Risk-free is 3%. Equity risk premium is 5.8%. Asset beta 1.25. Asset beta 1.6 for both the company. Assume that the beta of debt is 0. Okay. Financing of the two companies is given debt and equity. Okay. And Edison is planning to make a cash offer of 80 million to buy 100% of the shares of this. Cash offer will be funded by additional borrowing. How do you proceed this question? Tell me. If this question was given to you in the exam, how would you start? This is the area where you panic. This is the area where you should not panic. You start with asset beta. Okay, whenever they have given you debt equity and it is for valuation, start with the asset beta. Start finding asset beta of the combined company. That is your starting point. How do you find the asset beta of combined company? Just add. You know the individual asset beta of the two companies, right? 1.25, 1.6. Use it in the proportion of debt to equity. Okay. So Edison, if you add debt and equity, it will be 500 total. And here if you add, okay, wait, just first we'll take the asset beta of one company 1.25 into take this, it's 100, so the total is 600. Okay, so out of 600, 500 debt and equity is of this and 100 is for web. Okay, you are taking both the debt and equity, by the way. So for Athelstan is 500 over 600 plus 1.6 into 100 over 600. Which is equal to 1.31. See, it's in between these two asset beta. It should be. When they merge, obviously it will come down. Now, asset beta is done. Second step is don't stop there. Find equity beta of the combined company only. Okay, use the formula option. So once you found 1.31, okay, that is the combined company's asset beta into, you know the formula, 1 plus. Okay, numerator comes up, numerator goes down, denominator comes up. Okay, when we have to find the asset beta, equity beta, sorry. So it is 1 plus 0.7 into, because after tax, that's why we are taking 0.7. Okay, into debt. How much we are taking? Debt over equity. Okay, how much? What is the new gearing? You have to understand first of all, in the new gearing, what is the ratio? How much will be the new gearing? Come on. First of all, you have to find the debt equity of the combined company. Come on. See, debt, okay, of both the company, if you add 50 plus 20, it is 70. But with that, you have to add this 80 also, because this will be funded by additional borrowing. You will make a cash offer. You have to pay in cash. That cash you have to buy. So it will be added to your debt. So 70 plus 80 will give you 150. You understanding? 150 is your debt now. What about equity? What about equity? Equity, when you're taking, you are only taking this companies. Anderson, because he is taking over web company. But web company, when you're taking, you have to take both their Anderson company's debt will be taken, but web company 80 will be added with this 20 in the combined company when you're taking the debt. Understanding? You don't take the equity of the web company. It's only the debt, the new debt, because the debt ratio changed. That's why. So it's 150 is to 450. Because total it is 600, right? Total has to be 600. So out of 600, 150 is for debt, balance 450 is for equity. So when you're taking here 0.7, after tax it is on debt 150 over equity 450, which will give you 1.62. Make sure this is bigger than this. It should be bigger than 1.31 because this is the equity beta. How do you do this calculation in your calculator, by the way? You first do this part. First multiply 0.7 with 150 divided by 450, then add 1, and then you multiply at the end. Go backwards. You'll get 1.62. If you try to do it in any other combination, try to. If you're getting a different answer to this, it's a wrong answer. Because it's very easy for you to get confused with this type of calculation, especially when you're putting it in the calculator. Step 3. CAPM. Because you know cost of equity. Use it. 1.62. Risk-free rate is 3% plus 1.62 is the equity beta into risk premium. Risk premium is how much? 5.8%. Equity risk premium. So multiplied by 5.8%. 1.62 into 5.8 plus 3%, which will give you 12.4%. Now, WACC is already given. Cost of debt is given. So you can find WACC. How? 12.4% into your equity is 450 divided by total 600 plus cost of debt is already given as 5%, I suppose. Is it? It's pre-tax, right? Before tax. Go up and check. Yes, it's a pre-tax. So you have to find it after tax. 5% into 1 minus 30% because after tax into 150 is debt divided by 600 over 600. Total will be 10.2%. See, this will be more than cost of debt but less than cost of equity. It will be in between. Okay. Now, what else? Discounted free cash flow. Discount them. Free cash flow. FCF. So 50 is for one company, 10 is for another company. Add synergy with it. Divide the whole thing by 10.2%, that is 0.102, which will give you 637 million. This is the discounted free cash flow. Now, step 6, value of equity. How to find out? That 637, that is your net present value only. Discounted free cash flow is net present value. Deduct your debt. Debt is 150 equal to 487 million. So this is the value. You see? How much was the shareholders' wealth? You see your equity was just 450. From there it increased to 487. So this is the shareholder wealth. You understand? Because of this accusation, your shareholder wealth increased. Now we are moving on to the adjusted present value. How we can use it as a valuation and then a question. Now, how do you value a target using APV? There are 3 steps. Step 1, calculate the present value of the target's free cash flow using ungeared cost of equity as a discount rate. Even for adjusted present value in investment appraisal also we used ungeared cost of equity. So this is same. Then add that present value of the tax saved as a result of the debt finance used in the accusation. Okay, using either risk-free rate or pre-tax cost of debt as a discount rate, anything. Step 3, deduct the value of the target's debt from the value calculated in step 2 above. Okay, but then this value of the target entity can be compared with the accusation cost, whether it is worth it or not, whether you should go ahead with the accusation or not. Now let us do one question on adjusted present value before we move on to the valuation of debt. So in this question you have been given the free cash flow for the 4 years. Okay, ungeared asset beta is 1.2, risk-free rate is 3%. Okay, they are hoping to receive 75 million for the sale of their shares. Cash flow after year 4 are expected to stay constant in perpetuity. They have 50 million of 6% debt repayable in 4 years. Tax rate is 30%. Okay. So basically you have to compare the value with the 75 million and decide whether acquisition has to be done or not. Before I start this question, let me tell you, in your ACCA website, you have a technical article on business valuation. Please go and read it, because all the methods, market based, cash based, asset based, are discussed in that technical article. So now let's start this question. Okay. Starting point is this free cash flow, the 4 years. Okay. You start discounting it, but what is the cost of capital? You don't know. You have to find out. Ungeared cost of equity. Okay. So ungeared means you take this ungeared, multiplied with the risk-free rate, and do this CAPM model basically, right? Risk-free rate is 3%, cost of asset beta is 1.2, with that risk premium you add, which is 5.8%, it is 9.96%. You can use 10%. Okay, so discount all this 4 years free cash flow with 10%. Find the present value. Once you add all the present value, please do it yourself. Net present value has to be equal to 141.12 million. Okay, after that, second part, that is the financing part, present value of tax relief on debt interest. This is not as confusing as what we have done or not long that we did in investment appraisal, where we are given subsidies, subsidized loan, all those things. No, this is only on tax relief. Only on one thing you have to find present value. Because already they are giving it a question on acquisition and merger, they will not make it so tough. Adjusted present value, they will not make it so difficult. Okay, but if it comes under investment appraisal, yes, there they will make it a little. So you have to know which area this came under. But anyway, since you know the complex things, you have already done questions on adjusted present value. This is nothing, this is easier. Right? Now, how much? Find out the interest on 50 million, 6%, which is 3 million. And this 3 million, you will be paying tax at 30%, which is 0.9. Okay. And what else? You have to find the present value of this tax relief, 0.9. Right? And all the 4 years you are paying, so you can use annuity factor. Okay, multiply this by annuity factor for 4 years. But what discount rate? See, there are multiple discount rate that you can use. You have to state your assumptions. You can use 6% as debt. You can even use risk-free also, which is 3%. Anything is fine, but you have to state your assumptions. In this case, let's go with 6%. So when you're finding, go to annuity factor table for 4 years, 6%, find out. It will be 3.465, because you have to find the present value of tax relief. 0.9 is a tax relief. On this, you have to find the present value. That's why you have to multiply it with the 4 years annuity factor, which is 3.12 million. Now what? Adjusted present value. Add both. Net present value was 141.12 plus 3.12, which will give you 144.24. This is the value. From this, you have to deduct debt, 50 million, which will give you 94.24 million. And if you see this value, it is above 75, above the purchase price. So it's worth it. This acquisition is worth it, and you have to go ahead. That's what you have to recommend. Right? Now we are moving towards valuation of debt. This is very simple and very short. Okay, majority of it you have covered it in your investment appraisal. So for debt valuation, okay, especially for bond, you'll be given a bond because that is the complex thing. Okay, or even for any other type of debt, not just bond. The way you calculate is very similar. How? It is similar to the cash-based valuation model. Okay, so in short, value of the bond is equals to your present value of your expected future receipt, that is discounted at the lender's required rate of return. In this case, receipt are the interest and the redemption amount from the bond. Now let us do a small question on this. In this question, you have to calculate the value of each of their bond. So you have been given 100 nominal value 6% coupon bond in issue, redeemable in 5 years time, rate is 4%. How do you do this? It's very simple and very easy. Obviously in in AFM you will not get this type of question such easy, but you should know the easiest thing first. You first start with the present value of receipt. Okay, that is, what is the receipt? Interest as well as the redemption. So interest is at 6%. Okay, this you multiply for 5 years. That means annuity factor for 5 years at 4%. Okay, that is 4.452. I will write it here in so that you can use a table and find out. 5 years, 6%. Go to the table and find this out. You have to get 4.452. This is the interest part. With this you add capital part. Okay, the capital part is how much? 100, the nominal value. Multiply this with what? The 5th year's discount factor. So the 5th year's discount factor at 4% is 0. This also you can find out from discount factor table, or you can do it manually also and check. Add both, it will be 108.91. This is the amount of the bond. Okay, now let us estimate the required return. In this case they have given us the required return 4%, but they don't give usually. Then you have to estimate. And how do we estimate? Let's see, that's the next thing. So how do we estimate the required return for the debt holder? You can derive the yield by either of these two things. First, add a credit spread onto a risk-free rate. You'll be given both risk-free rate and credit spread in the exam, okay? Or you do it by deriving a yield curve for bonds with different redemption date. This also you have done it, okay? It is very similar to that. So you might first have to derive the yield on a bond and then use that yield as a discount rate. Understood? First find the yield on a bond, then use that yield as a discount rate to calculate the bond's value. Now, let us do two questions on this before we move on to what is known as high growth startup valuation. How do you value the high growth startups? So here you have been given the credit spread and you have been given a 5-year bond, A rated, risk-free rate is 2.5%. Now using this information, you have to find the value of the bond. Therefore, the yield on the 5 years bond is this, because it's A rated and for the 5 years. This. Okay, so you have to add this relevant credit spread to the risk-free rate, that is 2.5%. Okay, so how do you do that? This, the 5-year and the 99, so you add this with 2.5%. okay, 2.5 plus 99 basis point, that means 0.99. see, whenever they say basis point, okay, 99, you divide it by 100 and get it, okay, in terms of decimal, which will give you 3.49%. This is your yield. Okay. Now, this is using this you can discount. So all your future interest and redemption payment will be discounted using this 3.49%. That's why you want to have to find the yield. Now, in the second example, you have to issue 3-year, 100 per 5% coupon bond. Okay. You have been given the individual yield curve for the 3 years. Now, how do you do this? Discount the 3 years. Okay. 5% coupon, right? So in this case, it will be first year when you're discounting it. 5 divided by 1.0396 because this is the yield curve. Second year when you're discounting again 5 divide by this 1.0425 squared because this is for the second year. Third year it will be 105 because 100 plus that 5 divide by 1.0456 to the power 3 because for the third year. Okay, you keep adding all this 3. All the 3 are added and the total is dollar, I'll write it here, $101.26. This is the amount, this is the value per 100. Okay, so you will see, okay, that this value, okay, this is the value of the debt which you have to deduct it when you find the value of the company from the value of the equity. Now, in your ACCA website, there is a technical article on bond valuation and bond yield. Please go and read it. Okay, all these technical articles are very important for you, especially challenging areas like this. Okay, now let us move on to our next part of lecture, that is growth up companies. How do you value them? So now let us see that what are the features of startup companies and why it is hard to value a startup compared to established firms. Okay, because startups have little or no track record. Second, ongoing losses. Third, few concrete revenues, unknown or untested product, little market presence. So because of this, it's very hard to value a startup. And also, to add up with this, you have inexperienced staff. Okay, so because you have an inexperienced staff, they'll be having unrealistic expectations about future, regarding future profits. They don't have the past data to make predictions on the future cash flow, which makes it extremely difficult to value startup companies. See, in your exam, AFM exam, if this question is tested, this area, they will not tell you to value a startup. They will not tell you, but at least they will tell you the points why it is difficult, or why you cannot use a certain method. At least you should be able to give these points from there. That's the reason I've included it here, and it's important. Now, estimating growth. How do you estimate growth? Growth for a startup can be estimated based on few things. Number one, industry projections from security analyst, or some qualitative evaluation could be done of the company's management, marketing strength, and level of investment. This is just a discussion question. It's not so much detailed. Okay, it's not required. So much detail is not. They will not ask you also, and it's not required also. But both of them are subjective. Because they are subjective, it makes it very unreliable. Okay. So, since high growth startups, they usually cannot fund operating expenses or even investment needs also. Forget about investment needs because they don't have the revenue. First few years, they will not even have the revenue coming in. It's only cost, cost, cost. So during that time, they need a long-term financial projections. And high growth is one thing, profitable high growth is another thing. Understand this. Next, growth in operating income is a function of management's investment decisions. Okay, that means how much a company reinvest Because if it reinvest, then only company can grow, right? Second, effectiveness of the investment in achieving result. If it's very effective, you can estimate a higher growth. The market's acceptance of product and action of competitors will also tell you the growth. You can estimate growth based on that. If market is accepting your product more and more, means you can see there's a high growth. Even also your action of competitors will tell you your growth will be high or low. Management skill. Yes, if you have a good management skill, growth will be high. Riskiness of the industry. If your industry is very risky, growth will be questionable. Now, estimating growth. These are the valuation methods, okay? Since the estimate of growth is very unpredictable, so initial high growth can also easily stagnate or decline. Even if you're having a high growth initially, that also can easily go down or reach a point where it will not grow further. So valuation methods that rely on growth estimates, if you are valuing your company using valuation methods that rely on growth, it will be of not so much of use, little use, especially for startup companies. So in this case, what should you do? You can use cash. Cash is a key indicator of startup success. Very important. Cash is very important. And asset models are therefore an important starting point. So both asset and cash, you can see. Market is not so much good for growth high growth, because they do not have a track record, things like that. Okay, but cash and asset is there. You have an asset, you have cash, you can use it. But remember, even if you use it, they will not provide an accurate value to it. Why? Because since value rests more on potential than on the assets in place, it does not depend what asset you have at the moment. It depends on your potential to grow. That's where the value is, and it's very difficult to value that potential. So DCF, discounted cash flow models. Okay, if you're using cash flow model, okay, cash flow models are problematic because of the non-linear and unpredictable performance. First of all, they do not follow a line. That this year 30 million is the profit, the cash flow next year, so it will be 30. It's non-linear and unpredictable also. Sometimes you might have inflow, sometimes suddenly outflow. So it's unpredictable. Especially in the early years, it's very unpredictable. So in that case, this model is also, even if you use it, these are the problems. Okay, please understand the problem. So whatever the estimates you are doing based on that model are very highly subjective. Market base are difficult to apply because you have a problem of finding a similar companies. How can you find, you are a startup, it's very hard to find a similar startup to your company. Established, okay, you can understand also, but startup is very difficult. Now the last part of this lecture, problems of overvaluation. This question has been asked in the past paper multiple times, I think for 5 or 6 marks as a discussion question. Why firms are valued, why IT firms, why technological firms are overvalued, why tech firms are overvalued. This question always repeated, right? Why firms may be overvalued? Tell me some points that you can think of before I disclose the points. Number one, they do not understand, market does not fully understand the information that is available. Okay, in late 1990s and early 2000s, this was the case with high tech, telecommunication, internet venture. Why? They are very highly valued. That means they overestimate the returns that these companies are going to get. So they overvalue the equity. The price of the overvalued equity may not be corrected by the market. They do not correct if it is overvalued. Why? If these things are there. The data provided by manager is deliberately misleading. If they do it, they do not correct. This is a particular problem where the agency relationship within companies break down. If this happens, they do not correct. They let it keep it like that only. Second reason is if there is a collusion. What is collusion? Two or more big parties join together and charge high prices, right? So there is a collusion by gatekeepers. Okay. like audit firms or law firms get together, and many of them has been accused of knowingly contributing to the misinformation and manipulation. We have seen it in Enron or WorldCom cases. Why stocks were overvalued? Because even they contributed to manipulate the information, to give a misinformation, right? So because of misinformation and all those things also, equity could be overvalued. Now, what are the management responses to this overvaluation? How does management respond? They may be reluctant to correct, and this can lead to use of creative accounting to produce the results the city is expecting. See, because you told the shares are overvalued. What does it mean, overvalued? That means you expect that there'll be very high growth, high return from that industry. So in order to show that you are actually having that result, even though it is overvalued, you know it. Actually, your result is not like that, but now you're trying to show it. In order to show that high profit, high growth, you are now using creative accounting, which is not correct. Understanding? Second thing which management could do is, because of this overvaluation, is a poor business decisions. That means it's giving you an impression of success, but it is actually not a success. Because of that, you are making poor business decision. Third, poor accusation also. You have to pay a huge amount. Okay. Now, let's go through a case study to understand this problem of overvaluation even better. Let's have a closer look at Enron. So at the time, Enron's peak market value was 60 billion. Okay. And the company was worth 70 times its earnings and 6 times its book value of assets. Can you understand how big it is that time? Now, the company was a major innovator and a business had a viable future. According to this, but the senior managers, they were unwilling to see the excess valuation diminished. They do not want this excess valuation to go. They want it to be like that. So what happened? Rather than communicating honestly, okay, what did they do? They tried to hide the overvaluation. How? They tried to manipulate the financial statements, and they showed the value of new ventures very highly. Right? So because of this, what happened? By the time the market had realized this extent of the problem, the core value of the company had been destroyed. Remember, overvaluation today or tomorrow, for long term, you cannot sustain it. It's not good. You have to correct the mistake, because otherwise the market will correct. When the market realizes it, you will be thrown out of the market. Exactly the thing which had happened to Enron. Right? Now, what is the implication for this for valuation? See, in valuing a company, reported results form an essential core of data. Okay, whatever the results that you are going through the financial statements is very important in valuing a company. That is the core of data. You get most of the data from your reported results only, your financial statements. So since the reported earnings, okay, this reported earnings you can manipulate also to give favorable result. That is known as, the term is aggressive accounting. So because of that, remember, financial statements has to be scrutinized first and restated if necessary before using that financial statement as a basis for valuation. Before even coming to the valuation, first check how authentic or how accurate your financial statement figures are. If that is not correct, there's no point of valuing. You cannot rely on that valuation. Understood? Now, this is the summary of what we have discussed in this lecture. So let's summarize everything. We have started with cash based, market based, asset based. Starting with asset based, where we went through tangible and intangible. For intangible, CIB, leverage knowledge method. Okay. For CIB, we took return on asset. Either it is given to you or you have to calculate. Okay. With that, you multiply with asset base and it is deducted from your operating profit. That is your value spread. And then that value spread you divide it by WACC. And that is your CIV. This you add with your basic asset base model, where a ratio as multiply is given to you. You multiply it either with the book value or the replacement value. Okay. Coming to the market based, there are three. Price earning ratio. If it's PE, you multiply it with your earnings. If it's earnings yield, it is the reciprocal of PE ratio, 1 divided by PE. Okay. And if it's market to book, what is it? Market capitalization. You might be having some ratio and multiplied with the book value. Then we have the cash flow. We studied dividend valuation model and free cash flow. So in the dividend valuation model, the formula is given, and free cash flow is also the formula is given, right? So that's it for this lecture. We also went through how to value debt, the risk in acquisition, financial risk, business risk. So we choose a risk adjusted WACC, and also we used adjusted present value to value a company. Then we moved on to the valuation of the debt. Then we moved on why overvaluation is a problem, and then how to value a startup company. Okay. So thank you for watching, and see you in the next lecture. Okay. And next lecture will be on that is also another very important topic. That will be a small lecture, but important from the point of discussion, not calculation perspective, because that will be on regulatory rules and regulations on acquisition and merger. Basically, we are going to go through the defense mechanism, how a target company's managers might defend themselves from takeover. What are the techniques that they use? This is also a very common question asked in the exam, right? As a discussion question, which we are going to cover in the next lecture. So see you in the next lecture. Thank you for subscribing, and if you have not yet subscribed, please do subscribe so that you get the notification of my latest videos. And all the best for your upcoming exam.